Let me say something uncomfortable. You've seen this before. At $1,000, you thought it was crazy. At $10,000, you thought it was a bubble. At $30,000, you said it was too late. After every crash, you said it was over. And now, you're underestimating Bitcoin again. Not because you're uninformed, but because exponential assets are hard to process. Humans think in straight lines. Bitcoin moves in cycles. It crashes violently. It rallies harder. It shakes out weak conviction. It rewards long-term positioning. Every cycle follows the same emotional script: disbelief, skepticism, acceptance. Euphoria, crash, Bitcoin is dead. Then it repeats. The pattern is Bitcoin failing. The pattern is people underestimating it. Let's be rational. Bitcoin has a fixed supply, 21 million coins, that will never change. No stimulus, no emergency printing, no dilution. Meanwhile, fiat currencies expand indefinitely. Governments print, debt grows, inflation compounds. Bitcoin operates under the opposite logic. Programmed scarcity. Every 4 years, the new supply gets cut in half. In a world addicted to expansion, Bitcoin is mathematically restrictive. That matters more than most realize. Now look at what changed. Major asset managers offer Bitcoin exposure. Institutions custody it. Public companies hold it. Regulation is clearer than ever. 10 years ago, it was dismissed. 5 years ago, it was mocked. Today, it's integrated. That's maturation. Yet many still treat it like a casino chip. Why? Because volatility scares people. Bitcoin drops 20%, 30%, even 50% during cycles. That volatility feels dangerous. But zoom out. Each major cycle low has historically been higher than the previous cycle's high. That's structural growth disguised as chaos. Volatility is not weakness. It's price discovery. The real mistake people make is anchoring. If you first noticed Bitcoin at $5,000, everything above feels expensive. If you noticed it at $50,000, today feels normal. Anchoring is psychological, not fundamental. The real question is this. Compared to global capital markets, is Bitcoin still small? Yes. Gold alone is worth trillions. Global real estate is worth hundreds of trillions. Bond markets are massive. Bitcoin doesn't need to replace them. It only needs to capture a fraction. Capital moves towards scarcity, portability, and durability. Bitcoin is divisible, borderless, verifiable, and finite. That combination has never existed before. Now think about network effects. Bitcoin isn't just an asset. It's a network. Every new participant increases liquidity. Every institutional allocation increases legitimacy. Every regulatory improvement reduces friction. Networks grow exponentially. Most people underestimate exponential systems. They assume past performance limits future growth. But adoption curves don't move linearly. They accelerate. Here's another uncomfortable truth. Smart capital accumulates during boredom. Retail buys during excitement. You don't build wealth buying headlines. You build it buying uncertainty. Right now, we are not in mass euphoria. Your average household is not heavily allocated. Pension funds are not fully exposed. Governments are not aggressively competing for supply. That's not saturation. That's early integration. And this is where underestimation lies. Now consider macro forces. Global debt is at historic levels. Currencies continue long-term debasement. Financial systems depend on expansion. Bitcoin doesn't depend on expansion. It depends on code. In uncertain environments, neutral assets gain appeal. Bitcoin is politically neutral, borderless, permissionless. You don't need approval to own it. You don't need a bank to transfer it. That feature becomes more valuable over time. Let's talk asymmetry. Downside is capped at 100%. Upside is theoretically unlimited. That skew is rare. You don't need certainty. You need probability-weighted thinking. Is it likely that digital native generations prefer digital native stores of value? Yes. Is it likely fiat expansion continues long-term? Yes. Is it likely scarce assets benefit from that environment? Yes. Then why is skepticism still dominant? Because Bitcoin doesn't fit traditional valuation models. It has no CEO, no earnings calls, no quarterly guidance. It's an open monetary protocol, monetizing in real time. That makes people uncomfortable. Unfamiliarity creates hesitation. Hesitation creates delay. Delay increases price. Then people say, I missed it. But maybe you didn't miss it. Maybe you're just underestimating it again. You don't need to go all in. You don't need leverage. But ignoring a structurally scarce asset in a structurally inflationary world. That's not caution, that's avoidance. Even a small allocation changes portfolio dynamics because upside is nonlinear. That's how asymmetry works. And here's the key difference between early and late. Late feels safe. Early feels uncomfortable when volatility compresses. When pension funds are fully allocated. When governments openly compete to accumulate. When headlines call it stable. That's late. Stable Bitcoin will not be cheap Bitcoin. Right now, skepticism still exists. Doubt still exists. Underestimation still exists. And historically, that's when positioning matters most. So ask yourself honestly, are you evaluating Bitcoin based on current structure? Or old narratives? Are you reacting to volatility or analyzing adoption? Because if history repeats, and it often does, the biggest mistake won't be overestimating Bitcoin. It will be underestimating